What's up, founders? I am Chris. Welcome to Inside Startup Money. Today, we're going to break down startup valuation. I want to make this as simple as possible. I'm going to try to. Y'all know my method here. Before we get started, make sure you like the channel, subscribe, all of that good stuff. Now, here's what we're going to cover: valuation fundamentals, methods, practical applications, and implications. I promise I'm going to try to keep this as understandable, as surface level as possible. Y'all know me. So valuation is everything. The more a company is worth, the more people want to invest. That's what people say, but that's not always the truth. While high valuations create buzz, they also set higher expectations. So you could be valuated at a million, 10 million, 100 million, but then people expect high level results. And if you don't meet that, there's some consequences that come with that. So, what is startup valuation? It's the process of estimating worth of an early stage company. The process of estimating. You don't have an exact number all the time, right? That's why it's an estimation, right? It's because you don't have these details on the startups that you would have with other companies, right? So you got to factor in growth potential, the team capability, domain expertise, the opportunity, the size of the market. Like, is it growing? Is it shrinking? All of that stuff plays a factor. And now we have this AI thing. I think that's also changing the game too. So valuation is crucial because this helps you get investment. It helps you get better terms with investors. Like, are you going to have to give up more of your company to get that investment? Right? Like, how many shares are you giving away? Like, what's that process like? And it changes depending on your valuation. Also, when your company is valued higher, it's easier to attract talent because the people who are the employees, they think, well, if the company is valued at this high and I work for them and I put in work and I help them and provide my skill set and all of that, I get benefits of that. Some are looking for higher pay, some looking for equity, right? It depends on what you do as a founder. But talent is attracted to the highest level companies, right? So let's really break this down. Valuation method number one is the cost to duplicate. Again, I got my examples right here, so we're gonna break it down. I don't want to lose you yet. If you haven't liked the video yet, you gotta do that. It costs you nothing. Do it right now. Let's get into it. So the approach. This method calculates how much it would cost to build another company, just like this company from scratch. Simple. That's simple, right? I hope you understand that. What would it cost to duplicate this business the same way from scratch? Right? A smart investor theoretically wouldn't pay more than this amount. That makes sense. You can't be mad at that. If it would cost me $1 million to make this exact same company from scratch, you worth $1 million. I'm cool with that. That method makes sense, right? Makes sense? Okay. Excuse me. This primarily focuses on the development, what the cost is. That's huge with these companies now. The physical assets, right? Like, what, especially if you're a brick and mortar and stuff like that. If you're one of these, like, I'm seeing these engineer companies, more of the tech companies, like, they need a lot of actual, like, physical tools, machines. Bro, if we need $1 million machine to run this company, you're worth $1 million at that point, right? The intellectual property, like, what have you as a founder put in terms of the systems, the processes that's yours? What are the ideas that you've put in from here into this business? Marketing and infrastructure, huge. Like, how, I think distribution is something that's not talked about enough in this, but I think that's huge in this specific valuation method. Because if you have a higher distribution lever, right, a bigger one where you can put something out and you'll get a lot more traction on it, that's super valuable today. So what is an example? This is a SaaS project startup, right? They spent 200,000 on product development, 50,000 on marketing campaigns, and another 50,000 on allocated infrastructure, right? That means this company is worth around 300,000. Baseline valuation, right? I think this is one of the easier ones to like understand. Whatever you spent and put into it, we put a number on that, and that's what it's worth. Pretty simple, right? Now, valuation two. This one is a little more complex, but stick with me. Stick with me. This is the value of a startup comparable to companies that are priced in the market using revenue or user multiples. revenue or user multiples, one of those two, or it could be both, right? This is when a startup has established revenue. That means you have to have some kind of traction. You need to have some kind of results, right? Similar companies exist with known valuations, right? And this is especially important now with this AI stuff, I think, because we're seeing a lot of duplicate companies, whether it's the personal assistants, different project management tools, all of these products, the content creation stuff, repurposing. A lot of these products are duplicates of each other. And because there's so many of them, you can tell what each one is worth. Simple. How many users do you have? What are you charging a month? How many users they have? What are they charging a month? We already know what it is at that point. Now, the common multiples include like the revenue, like I said, the user and customer acquisition cost. How much does it cost you to get one of those users, right? Like, how much money do you have to put in to get in one of them? From the advertising to the funnel to emails you send, all of that stuff. How much does that actually cost? And then the EBITDA multiple for mature startups. This is for companies that have been out there for a while, right? So on the I hate when I do the slides way too big because y'all can't see it, but let me scroll a little bit, right? So if a company has $1 million revenue, annual revenue, that's one multiple, right? Then you got 5x industry multiple, average valuation for comparable SaaS companies. This is industry multiple. This is really key. This is why I think it's good for you as a founder to study your competitors, to see what results they're getting. That'll tell you where you are, right? Because a lot of these companies put out their numbers on their blog, press releases, all of that stuff, because they know if they put that out there, it makes it easier for them to attract investors. So you as a competitor can easily see what their numbers are. Go and research it, study it, learn that stuff. So this company right here will have a $5 million valuation, 1 million annual revenue, a 5x industry multiple. There it is. I think this one was really, I hope you understand this too. If you with me, let me know down in the comments. I don't want to leave y'all behind. I don't want it to be too confusing. Number 3, and I made these different, very bright colors so you can easily understand all of them. That's why they're the crazy colors. So rock with me, man. Rock with me. This one here is the discounted cash flow. DCF values a startup based on projected future cash flows, discounted back to present value to account for time and risk. I know that sounds really complicated, so let's break it down piece by piece to really understand this, right? A lot of construction outside. Projected future cash flows, right? That means what does it look like your company is going to do based on what you're doing? This is why the traction you have matters if you're using this valuation method, because they're looking at what results that you already gotten, right? So this method emphasizes long-term growth, accounts for the time value of money, right? In terms of inflation, all of that stuff, incorporates risk, right? With the discounted rate, and requires detailed financial projections. Like, this is probably the most complicated one when I was researching and studying. And I'm not going to sit here and act like I know all of this. It's not perfect. It's not perfect, but I know a little bit now, right? Like, so using a 15% discount rate to account for risk and time value of money, this valuation for this company will be $2.2 million, right? And this says, just to hover over it, this says if the projected cash flow year 1 is $500,000, $500,000, million in year 2, and then $2 million in year 3, that means the expectation is to, the valuation is, we're going to pull all that together at a discount, you'll be at $2.2 million. That's the value of your company. My bad, people, my bad. Valuation method stage 4. Now, again, I know this looks terrifying, but stick with me. I'm trying to keep it simple, man. I make these things because they help me learn. I'm sharing this with you on this channel because hopefully it can help you learn. I'm trying to help everybody win, because as I'm learning, I want to make sure everybody else can learn too. So this is kind of based on different stages of the company. So I'll go through and break each of them down. So the idea stage, the typical range is $250,000 to $500,000, right? That's, again, we're talking about the value of the company, not exactly how much you will get invested from a company or how much an angel investor would give you or how much money you've made. We're not talking about that. We're talking about the overall value, the overarching value here. Idea stage is up to 500,000, right? Business planning concept. And when I say business plan, bro, I'm not talking about a basic like Canva 3-page business plan. I'm talking like the 50-page business plan. That's like the really long, thorough ones. That's what you need to get that, you know, 500,000 in funding. Yeah, you have to have that. This is based on founder experience, market size, innovation level, that kind of stuff. It matters for sure. Now, the prototype, this is the MVP stage where you might have something that's working that a founder can or a VC can see. That's huge. From my interviews with VC, this is where they really start taking companies serious at this prototype stage where they have, if it's software, they can see that. If you've built something that's actual physical, like your engineer, they want to be able to see it and touch it. Like that's the stages where they take you more serious. Working product with early users or beta testers, right? Some initial validation. This is why I closed beta in this area. This is huge. It's huge. It could be a game changer for you to have 25 users on there that are getting results that love it. That could be all you need to really get that VC to say yes. Revenue stage. This is 2 million to 5 million, right? You're generating revenue. It's consistent. You're getting results. At this level, it's where you're going to more easily be able to have that conversation with an investor, right? You can demand more because you're like, look, we're very, very profitable already, you know. And if you bootstrap to 2 to 5 million, a lot of founders are staying in this space now where they're not raising at all. They're just, I don't want to raise anything. I'm gonna just work with this company. I'm gonna make this money, scale it, and then after I get to 5 million, I can sell it for 3, 4, 5x, and never work again. Like that's an option too. Keep that in mind. Now the growth stage is 5 million to 15 million. This is when the revenue is significant. You're growing, you're scaling, you're everywhere. So this is the stage-based approach. Stage-based. Choosing the right method, right? Cost to duplicate. This is best for pre-revenue startups, physical product companies. Like if you're building something with your hands, you're out there, like even if it's, I've seen companies are like building, making like the clothing companies and stuff like that. Cost to duplicate. Go that route, right? The limitations is it ignores potential market size, but I think that's a good trade-off, right? It's a trade. You can't have it all. You cannot have it all. Market multiples. This is best for startups with established revenue, companies in established sectors, right? You're in a market where it exists already. So you can point to a competitor and say, look, this is what it is. This is what's happening. The downside is this requires comparable companies. You got to have competition, right? And you also undervalue unique business models. So it's a downside to it, but I think this is where you're going to get more results easier because you have those competitors. Because one thing VCs hate, and I've learned this from my interviews, is when you say you don't have competitors. Like they hate that because in their mind, there's always some company out there that exists that does exactly what you do. And a lot of times they are right. Discounted cash flow, right? This is best for startups with predictable revenue models and late stage companies. See, this is not something that early stage founders should be using, right? This is highly sensitive to growth projections and discount rates. So you're probably going to do a lot more negotiating and debating on this level. And most founders are trying to do this if you are raising stage based. This is best for very early startups, first time founders seeking initial funding. I told you, that's just the best place to go, man. The ranges that you have that you can work from, it makes it easier to understand for the VC, for you. Now, it does have a downside because depending on your market, you may need more or you may be worth more, you know, because you're in a specific market with a specific skill set and all of that. But I still think if you're an early stage founder, stage-based and market multiples are going to be the best for sure. Most sophisticated investors use a blended approach, combining multiple methods to arrive at a valuation rather than a single number. It's good to know. Good to know as a founder. And to be clear, I'm talking about this all from a founder, from a VC/founder perspective, kind of like in the middle. Because I'm talking to VC so much on the Next Round Ready podcast, I kind of wanted to make this one to show you what they're thinking a little bit. And then I think you as a founder should start thinking like a VC too. You got to understand how they think and how they process. So it's easier to get what you want from them. You know, it just makes sense, right? Value drivers are growing users, growing revenue, experienced team. That's huge, man. They care about that, having that domain expertise. That just matters to them. Total addressable market, 1 billion plus. I know that sounds crazy, and you could get away with that. But if you have this size of market of 1 billion plus, you'll be able to get funding if your idea is good. That just means you have a lot of money to be made there. Simple. Patents, hard to replicate innovations. I know a guy who had to build a whole machine to build his product. You can't copy him. He had to make a whole machine, an entire machine to make his product. You're not copying him. And I don't care how hard you try. You're not copying that guy. Like, he's built a machine. It's not happening. Network effects, I think that's huge, man. Having the right people, and then those people can go and get the right people, and they can just kind of spread like wildfire. That'd be huge. Now, value killers, unrealistic projections. This is another one of those. This goes up there with the I don't have competition. Like, when VCs hear this, they hate it. Like, I asked like maybe 5 the past month what they hate the most. Those were like top 2 for sure. Like, unrealistic, when you go in there with your deck and you're like, yeah, we're at $0 right now, but within 2 years we'll be at 10 million. They're like, how? Like, you need to have some kind of proof before you can throw numbers out. That's what I've learned essentially. High cash burn rate. We talked about this in another lesson. I hope you know what burn rate is, but if you burn in cash too fast and you're not making enough, that's a problem for investors, right? Incomplete team, you want to have those people on your team. I found that even if you don't have team members, if you're contracting people, you can still be able to get results with that, and that can be fine. Regulatory risk, this is huge on the legal side. This is why products in the healthcare space, I think some of the AI stuff will see a lot more of the legal issues coming up soon too. That's something to watch out for. This is my prediction episode, but I just had to put that out there. Limited competitive moat. If it's easy for others to copy, you're going to lose a lot of VCs, man. They want to have that high level upside where there's competition, but you can dominate the competition essentially. That's what they want. So here's just a toolkit for you to help you with the valuation side of things. Number 1 is benchmark your metrics from day one. I think the cost to acquire a customer, lifetime value, your website visitors. Like, as soon as you decide on the startup and you buy a domain, you should have a pixel set up on that website so you can track everybody that goes to your website. Like, day one type stuff. That's the kind of thing you got to be doing as a founder. Compelling story. I'm always telling founders, like on my show, Next Round Ready, about making content. You got to tell your story. You got to. And the content is great because it helps you tell your story without having to sit in front of the VC, right? You could schedule a meeting with them and go in. I would say this is something I've taught. Again, I'm having these conversations all the time. Having that content on your LinkedIn, your website, posting it on Twitter helps. Because if you do connect with a VC, even if they tell you no, if they go and look you up later, they can see your content and your story, and that could be the thing that makes them want to work with you. That's how powerful content is in telling your story. Value-based pitch. You got to, if you haven't, you got to check out my episode on my show Next Round Ready with Dana Robinson. She talks about pitching. Oh my God, it was so good. Really, really good interview we did. And she breaks it down in a really good process. She helps founders with their pitches. You got to listen to the episode because it'll show you how to create a pitch that's like valuable to them. And it's not just you begging for money. And you're not, again, making those crazy projections, or you're presenting your value and why they should work with you, right? It's a process, man. It's a process. And then master the negotiation. You want to master this so you can really operate at a high level. So a couple key takeaways, man. You got to understand these because it's going to make you a better investor. It's going to make you a better founder. If you're trying to raise, all of this is going to make it easier for you to really understand how these things work. I'm doing this research myself and learning this stuff, and I'm not even raising right now. If I was raising money for a startup I was making, this is the kind of thing I would have to know before I started raising. It's only going to help you raise money a lot easier. So, man, thank you guys for tuning in. Thank you for being here. Again, if you didn't like the video, why did you like it? If you're still here, like the video, subscribe to the channel. I'm Chris. I will see you next time.